As accountants, one of the most common things that we do is prepare financial statements like a profit and loss report and a balance sheet report for a company of a specific period. Most common thing is preparing profit and loss and balance sheet for last year so we can prepare a tax return. Now, small business owners are usually concerned whenever they look at a profit and loss. For example, let's look at this profit and loss over here. And we're looking at all the revenues and all the sales, and then we're looking at all the expenses, and all the way at the end, we have an amount representing the net income. Net income is very usually the number that's going to represent how much taxes that business or that business owner is going to pay, because net income is typically taxable income. Now, in many cases, it's not, but that will be a subject for an entire different video. However, the main concern is the net income, and I'm going to switch over to the balance sheet, doesn't match the total money in the bank. As a small business owner that doesn't understand accounting or accrual basis, it is normal to say, hey, if I made this much money, there should be at least that much money in my bank account. However, in accounting, profits not only come from cash. Sometimes profits are affected by other components in the operations. So in this video, I'm going to explain how to tell the difference between net income and money in the bank and help you understand or explain where is the money, where is the cash, and to answer that proverbial question that us accounting professionals are answering almost every year to almost every one of our clients. So the first thing we're going to do is we're going to pull up a profit and loss in QuickBooks or whichever accounting software you're using. And you want to make sure that the date period that you're looking at for the profit and loss, in this case, this is January 1st, 2019 through December 31st, 2019, is the exact same date period as your balance sheet. You need both reports, profit and loss and balance sheet, to be able to pull this off. So notice that in my balance sheet, I also have the exact same period. So that's step number one. We're looking at the two reports next to each other. Step number two, we're going to click on where it says compare to another period, and we're going to select previous period with dollar change. In the balance sheet, you must know what changed in my assets and what changed in my liabilities in order to understand where the money went. So we're going to do that comparison and click on Run Report. Once we do that, you're now going to see three columns in your balance sheet. You're going to see the first current period. So that's as of December 31st, 2019, all the balances of all my assets, liabilities, and equity. And then the date that it is comparing to, which is basically the same date the previous year. Basically, everything that changed in the third column is going to explain where the money went. So in other words, we're going to take the profit and loss number, which is right now saying it's $56,152. We're going to compare it against the current balance in the bank, which is $8,751. And we're going to look at all the components that made that variation happen. So I went ahead and exported the profit and loss and the balance sheet into Excel so we can explain the formula, basically mathematically, how exactly we get to the difference between cash in the bank and net income. I went ahead and highlighted the total bank balance that we currently have, and I went ahead and highlighted the total net income because those are the two numbers that apparently are giving us a difference. So what I'm going to do is under net income, I'm going to show you all the changes in the balance sheet that had caused that cash to go down or to go up. So basically we're going to explain where is the cash. So where is the 56,000? So the first thing we want to look at is go into the balance sheet, and we want to see the difference between the beginning balance in the bank and the ending balance, which in this case is 5,001. So our bank should have gone up, according to our profit and loss, $56,000 if all the money had gone into the bank, but it actually only went up $5,001. So what we're expecting to have in this case is to have our beginning balance plus our net income. That should be our total money in the bank. So I'm going to start putting all the lines in the balance sheet that's supposed to make our cash go up. So I'm going to come in here and put beginning balance, and we'll put this number, which is the 3750. And I'm going to scroll. Let me change this formatting to dollar amount. And I'm going to scroll all the way down here, and we're going to type here total cash on hand. Okay, perfect. So if we had started with 56,000, okay, and we were to add, in this case, the beginning balance, in theory, if 100% of my profits would have stayed in the bank, I would have $59,000. So we're very far away from the proverbial 8751, which is the current balance, which obviously we need to do a lot more things here to add the number. So the beginning balance would essentially increase that net income or the net cash in the bank. So we're going to type we're also going to add here all the other changes that would eventually make the cash balance go up or down. So we're going to go down the balance sheet and we're going to look at the changes of each one. So let's take a look at the changes in accounts receivable. Let's highlight this orange. So if you can see here, our beginning balance in our accounts receivable was 2250. That was the beginning of the year. My total open invoices was 2,250. At the end of the period that we're looking at is now 17,431. What this means is all the income that we booked in our profit and loss, not all of it was collected. At least 15,181, it's still outstanding. So having obviously that money outstanding, that would be one place where the money went or where the money is. So in this case, we're going to put here increase in accounts receivable. And an increase in accounts receivable is going to lower the amount of cash in the bank. It's going to lower it because our clients have not paid us yet. So we look at this total cash on hand here. Let's make sure that we are using a formula that will add up all these numbers for us. So I'll go ahead and add that here. And down here in the bottom, there will be a tally of the total money that we should have in the bank. So we have 3750 at the beginning of the period, 56,000 in net profits. However, $15,000 have not been paid to us. This is why if at this point, I should have $40,000 in the bank. However, that still doesn't explain the 8751 that we're trying to get to. So the next numbers that we're going to look at is our other current assets. So notice that there are two other current assets that actually had net increases. Our inventory asset went up by $596 and our undeposited funds went up by $2,062. So our inventory asset is an investment we make into inventory so we can sell it in the future. If our inventory goes up, that is one place where our money went. So we can explain part of where the cash went by looking at inventory. So let's do here increase in inventory, and we're gonna put equals, and then we'll do the negative balance of that positive change. Again, let me just change the formatting. The reason for inventory reducing my cash is because I took some of the profits and I invested it or used it to buy inventory. So we'll look at our next line here, which is going to be our undeposited funds. So these are the total monies we received from our clients, maybe in checks, that we still have not put into the bank. So obviously, if it's not in the bank yet, it's not going to show in the bank balance. So that could be a check sitting on my desk waiting for me to go to the bank to deposit it tomorrow. So we're going to put here increase in undeposited funds. Okay, and we're going to take the negative balance of that positive change. Perfect. So notice that our cash on hand is going down. Our next one that we're going to look at is, and let's go ahead and mark these two orange as we complete them. Next one we're going to look at is our net change in fixed assets. So it looks like we purchased a truck for $13,495. So we had a net increase in assets. That means that we took some of our profits and we used it to buy a truck. And the truck is sitting on our balance sheet as part of our business value. So we're going to go ahead and put here investments into assets. So we'll do investments into fixed assets. And we're going to bring in that number again as a negative amount because that's where some of our cash went. There you go. So now our net cash is on 24,000. Again, we're not quite there on the 8751, but we're getting there. So we went ahead and took care of that fixed asset. All right, so we're done with our assets. Now let's take a look at our liabilities. Now liabilities have kind of an opposing effect. If my liabilities go up, that means I owe the money. My debt goes up. That means that instead of me paying that debt, I took on more debt. So in theory, that increases my cash, or at least it doesn't decrease my cash that I would otherwise would have used to pay that debt. So any increases in liabilities is basically more cash in my hand. So this is going to have an opposite effect. This is actually going to increase my cash. So we're going to put here increase in accounts payable, and that's going to be a positive number. So we're going to take the positive difference in this case, not our total accounts payable value as of the end of the period. We're essentially going to take the change. So we have this third column here that measures the change. So that's going to increase my cash. Okay. Then we're going to come down here. Let's mark this one orange because we already finished it. Let's take a look at our credit cards. So notice that we have 2 new credit cards with a balance. Again, we use the credit card to make expenditures. Our expenditures made our net income or our profit go down, but we didn't pay the credit card or we took on credit card debt. Our credit card balances went up, which means that puts more money in our pocket, or it doesn't make us spend the money. So you can see it in both directions. So we'll go ahead and put here increase in credit card debt. Let's call it credit card balances. Okay, and that would be a positive number. In this case, these 2 numbers went up. So we'll bring that up as a positive number. Okay, let's go ahead and mark these 2 credit cards here orange because we already went ahead and took care of those. Let's take a look at other current liabilities. So in this case, we have an increase in these 2 numbers, Board of Equalization payable. That's a payroll or sales tax that we owe to the state. And then a loan payable, maybe a short-term loan that a friend or a different business lent to the company. So we're going to take a look at the 2 increases in other current liabilities and increase those as well. So we're going to do increase in other current liabilities, and we're going to bring in that number as a positive number because in this case our current liabilities increase. So let's go ahead and mark these 2 with these 3 over here orange. And then we have our long-term liabilities, which are maybe long-term loans that I'm going to pay maybe more than a year into the future. Notice that there's actually no change there. So that's going to be a 0, but I'm going to put here increase in long-term liabilities. Perfect. So I'm going to bring in that number. That's just going to be 0 in this case. And that will be it. So far, our net income is $56,000. Based on the other items that we could explain, we're supposed to have $36,000. So we still have a difference, and the difference is going to be in the equity section. So let's go into the balance sheet and let's take a look at our equity. So there's a couple of things which are changes in our equity. So the first thing we're going to see is we had a capital distribution. In this case, notice that our owner's capital or a distributions account went deeper into negative. Exactly went down by $31,000. This is probably us paying personal expenses as a business owner, paying personal expenses with our business, or taking out cash distributions to the owners. Obviously, taking cash distributions to pay the owners decreases our cash. So that difference is this $31,000. So we're going to come in here and put here decreases in capital or increases in distributions, right? So an increase in distribution would be a negative capital. Putting money into the business would be a positive capital. So in this case, that's money that we can explain that money went away. So in this case, we're going to bring in that negative number. We don't have to change the polarity. That's going to be a straight negative number. And then here's the total cash on hand, 5,001. So now what we do in this case, we're going to add on. So this is going to be the total new cash on hand. Let's call it total new cash on hand. That's a 5,001 plus our beginning balance, which in this case is 3750. There it is. And this will be our cash on hand, which is basically adding up these 2 numbers, that plus this one. Okay, we'll change the formatting of this one. So there we go. In summary, let's go over quickly. Why would I have a difference between my net income and my cash balance? Particularly if my net income of my net profits is a larger number than the total money in the bank, this could be explained through the following things. 1, I have increased my accounts receivable. That means my customers haven't paid me. Obviously, you will not be seeing that cash in the bank. I have increased in inventory. I have taken part of my profits and I used it to invest into having more inventory in my business. Increasing other current assets. We talked about undeposited funds, but it could be other things like putting maybe a security deposit towards buying a property or towards your rental. That's obviously going to use some of that cash and it's going to be tied up into that current asset. We can have a purchase of a major fixed asset. So if you buy any new assets, obviously that's where some of your profits went to be invested into that. We can have a decrease in accounts payable. That means that we pay down some of our vendors. That's where we could use some of our profits to do that. We could have a decrease in our credit card debt. So if we pay down our credit card debt, obviously we're using some of those profits to pay down that debt. We can have a decrease in total liabilities or debt or maybe bank loans. So if we pay down our loans, our cash is going to go down. And finally, if we take out distributions to pay the owners or pay personal expenses through the business, which is the same thing as a distribution, essentially makes the cash go down. Anyway, if you don't have an accountant that can help you understand these differences, especially when it comes to tax planning, understanding the profits that you could potentially pay taxes on through your business, considering hiring a local professional, or my emails on file if you want to ask me any questions about it. Hopefully this video was helpful. If you liked it and like more videos like this, add some comments below, subscribe to my channel, and I'll see you on the next one.